I'm Roger Montgomery and welcome to this week's Video Insight. We've recently alerted investors to the possibility that the maturing bull market, which began at the end of 2022, is showing some signs of morphing into a bubble. Anecdotal evidence includes multiple profitless companies rising 300%, more than 60 US listed companies commencing Bitcoin reserve strategies reminiscent of the special purpose acquisition companies or SPAC craze of 2020 and 2021, elevated margin debt, extreme concentration among AI names, as well as extended valuations in those same companies. And at the same time, an MIT report revealed that 95% of adopted business AI projects have failed. It could all arguably point to bubble-like conditions. Perhaps this is all just big picture stuff, and we should be looking a little more closely at other indicators. If so, what are the bulls pointing to that justify the view that the market should continue rising? Well, the first observation is that market breadth, the number of companies participating in the rally, is increasing. Market declines tend to, but not always, follow a period of declining breadth, and the reverse is occurring right now. More stocks are joining the rally. This indicator rising, however, isn't a reliable buy signal. More reliable is to add to your investments in equities when breadth is on its knees, when the breadth indicator is below 25%. Be greedy when others are fearful. The second piece of evidence the bulls point to is that more than 80% of US companies are seeing positive earnings revisions. With more than 95% of S&P 500 companies having reported their second quarter results, corporate America has beaten expectations. The S&P 500 had a relatively low bar to clear of just 4.9% earnings growth expected for the quarter, but America's largest 500 companies are tracking towards 11% year-over-year growth, more than double the level expected at the start of earnings season on July 1. Another pointer for the bulls is the emerging strength in microcap, frontier and emerging market stocks. They generally have lower levels of liquidity and higher volatility, and that's been keeping investors sidelined for several years, but now it appears confidence is returning. But as you've probably already noticed, some of these indicators could just as easily be argued to be signs of the market boom being in a late stage. Every bubble in modern market history has been based on a thematic or a narrative. In the past, it's been the internet or real estate. Whatever it is, investors and proponents see it as a source of unlimited earnings growth. That theme today is unquestionably AI technology. But this time, valuations aren't as extreme. Sure, PEs are high, but they're not as high as during past bubbles. And this time, many of the AI leaders are also generating billions in quarterly revenue. This isn't vaporware. And what about volatility? Well, there's little doubt with Trump at the helm, we can expect the unexpected between now and 2028, and maybe even beyond. More immediately, as you can see in this chart, the VIX tends to rise between now and November. Not always, but mostly. And greater volatility might mean lower prices. As always, we'll only know if this is a bubble on the other side of it. Some of you will subscribe to the view that it's better to be 6 months early than 6 minutes late. If that's you, then all you need to do is undertake your scheduled portfolio rebalance now and bring weightings across asset classes back to their initial weights. For some, it's enough that Warren Buffett is holding on to record cash. And for others, well, they're just happy to be earning 7 to 9% a year in private credit funds without any exposure to public markets at all. My view is, if you have a framework and a process for investing, it doesn't matter what you think the market will do. Your investing strategy and process, tied as they are to your risk tolerance and financial personality, will help you navigate whatever the market or Donald Trump serves up. That's all we've got time for, and I look forward to talking with you again next week. In the meantime, continue to follow us on Facebook and X.